John Mondillo, this week we get the final money market reform compliance deadline. But before we talk about how it's going to affect yields and opportunities, what are the basis for these rules? How did we get to this point?
Well, following the 2008 financial crisis and the collapse of Lehman Brothers, we saw a number of different problems take place in the money market fund industry. Number one, we saw the reserve primary fund, a large money market fund, break the buck, which brought about these changes to money market funds. Big changes that are taking place later this week are three things. Number one is moving to municipal bond funds and prime bond funds, money market funds that is, moving to a floating NAV, and 2 and 3 being the addition of gates and fees on redemptions from those funds.
And this has been happening all year. We're just at the final deadline. So how has money been moving? Where has it been moving so far this year?
Well, it's funny. I think if you look at the trends of movement of money, we started out the year in the tax-exempt space at about $250 billion in municipal money market funds. That has sort of creeped down, and over the last 3 months has really lost assets in the space to, up until last week, we're about $120 billion. In the prime space, it's gone from about $1.2 billion to start the year to now about $600 billion. That money, by and large, we've seen shift over to the government money market funds that aren't under these stringent regulations such as a floating NAV. It's been sort of a flight to quality.
All right, so where are you seeing opportunities because of this flight to quality in the Alpine ultra-short muni income fund?
So it's created a little bit of a structural imbalance at the front end of the municipal bond curve. What do I mean by that? I mean that we're seeing that variable rate demand products and even short-term notes to a certain extent have really ratcheted up in yield. Where we used to see in the end of 2015, beginning of 2016, we saw VRDNs, variable rate demand notes, which typically are what municipal money market funds buy, go from about 1 basis point in SIFMA, which is an index that tracks these notes, to where we're at right now, which is at 87 basis points. So for the Alpine ultra short municipal income fund, we use that to our advantage. We see those attractive yields, those relatively safe investments, and we sort of funnel assets into that asset class.
All right, so as we head towards the end of the year, we have a few big things on the horizon. We have the election, we have a potential rate hike and probably in December. So how will this affect what's going on at the short end, the ultra short end of the muni curve?
Great question. Well, I think it's important to have positioned yourself well headed into the October 14th municipal money market fund sort of regulation deadline. But I also think it's important to look beyond that, like you said, into the November election, into the December possible rate hike. It's very important that you're staying defensive, which is something that we've done at Alpine Funds. We positioned the funds for volatility. We've seen volatility this year, and we feel that we're going to continue to see that volatility. So we've positioned the fund for that.
All right, well, thanks a lot for coming on and talking about it.
Great pleasure.
And thank you for watching The Street.